In the world of investing in the stock market, exchange-traded funds or ETFs have become one of the most popular methods of building wealth and generating income for both seasoned investors and newcomers alike. Now, this is because they offer diversification, liquidity, and the opportunity to not only harness growth but also cash flow alike. Now, when it comes to generating a passive income stream, it's hard to find the perfect dividend ETF that offers consistent cash flow without sacrificing potential growth for the ETF too. But in this video, I'm excited to introduce one of my favorite dividend ETFs. An ETF that doesn't always grab the headlines, but has consistent dividends, solid returns, and is a very reliable income stream. Now, whether you're a passive investor seeking long-term growth or more of an income-focused individual like myself, looking for reliable dividend payments on a monthly basis, the DIVO ETF aims to cater to a wide range of investment objectives, and we are going to go through all of it. Right after you, please drop a like in this video and subscribe for more content like this in the future. Now, even though this ETF might not be a household name, you are definitely going to want to stick around and learn more about it. Now, the dividend-focused ETF that I'm talking about is none other than abbvie ETF's DIVO, or the abbvie Enhanced Dividend Income ETF. So heading over to the website, it says, why invest in DIVO? Income potential, comprised of high-quality dividend-oriented stocks, along with covered calls on individual stocks. An active management plan allows the portfolio manager, the CWP, to identify opportunities and risks and act on those decisions in real time. So with this fund being actively managed, you are going to pay a little bit higher expense ratio of just 0.55%, which in my opinion is definitely worth the price. Also, DIVO seeks to lower volatility. Dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. So in a situation where the entire market might be selling off like crazy, DIVO, for example, most of the time is going to have a much less movement, much less beta, which is perfect for more of a conservative income-focused investor like myself. Now, looking a little bit deeper into the DIVO selection methodology, it says dividend growers. DIVO is managed with a strong emphasis on owning high-quality large-cap companies with not only historical dividends, but also earnings growth. Sector allocation, DIVO is relatively balanced among the traditional 10 S&P sectors, with CWP determining which sectors to over and underweight based on various factors, which of course can be changed over time. Also, security selection. DIVO consists of 20 to 25 stocks, which are screened and adjusted accordingly according to attributes including market cap, management track record, earnings, cash flow, and lastly, maybe my favorite aspect of this entire fund, covered call options are written on individual stocks on a tactical basis, not an index approach. For those that might not be aware of it, covered calls involve buying shares of a stock and then writing call option contracts on some of those shares. A covered call could also be referred to as call writing or writing a call option on a security. And for beginners out there, it's going to be a little bit confusing because there are different terminology and different ways to say the same thing. For example, if you want to sell a covered call, you could also say that I'm looking to sell an option. There's many different ways to say it, but they all pretty much mean the same thing. So other investors can then purchase the call option that the sellers are of course selling to them. Now for the contract buyers, they pay a small fee to the call writer, known as the premium for doing so. Now the contract gives the buyer of the option the right, but not the obligation to buy shares at a specific price on or before a specified date. In the case of call options, when the share price of the underlying security rises above the strike price that is agreed upon, an option holder can choose to exercise the option, at which point the stock could be called away from the person who wrote the call option or that sold the call option. Now the whole point of this is that the option holder then receives shares at a cost lower than the current market value, and that's sort of the value of buying call options. Their profits will equal the difference between the option strike price of what they agreed upon and where the stock is currently trading minus the premium paid. The higher the stock price rises before the expiration date, the greater the profit for the person holding the call option could be. Because the call option writer receives the income on the deal in the form of a premium, they want the stock price to either stay flat or fall or slightly rise in order to basically keep their shares, but also, of course, make some massive profit off the premium. So a lot of the covered call ETFs out there, they buy into an index and they write a covered call on the index, which is sort of an easier, less management intensive way to do things, but DIVO writes calls on individual stocks, which I absolutely love. Next, looking a little bit deeper into DIVO's actual holdings. The holding breakdowns, his financials at 18%, consumer defensive at 15%, healthcare at 14%, technologies around 12%, consumer cyclical at 12%, industrials at 12%, energy at 10%, utilities at 4%, basic material at 2%, and communication at 2%. And as far as cash bonds or others, because yields are so high right now, we're seeing Devo hold around 17% cash bonds or other. which I think in my opinion is a great move. Now some of the top holdings are things like bonds, Visa, Procter & Gamble, Microsoft, United Health Group, Chevron, Apple, McDonald's, JP Morgan, and the Goldman Sachs. And like we saw a little bit earlier, DIVO does have around 25 to 30 different holdings within the portfolio. Now looking at DIVO's performance since around December of 2016, so this ETF's been around for 8 years or so. The price return is actually pretty good, up 43.23% without even including dividends. Now year to date, DIVO is basically flat, up almost 1%, and this is likely because of the exposure to the financial sector. But looking deeper into one of my favorite aspects of this ETF, the nice steady monthly paid dividend. DIVO's trailing 12-month dividend yield is around 4.74%, which isn't necessarily all that great considering rates are so high right now, but if you bought into DIVO when I did a few months back, your starting yield is definitely going to be north of 5%. But looking at DIVO's dividends paid out historically, there is a very consistent payment of around 14 or 15 cents every single month for the last many years. So with a high quality basket of holdings with the covered call strategy on top of it, a nice substantial consistent gain in overall ETF price historically, and a steady amount of cash flow paid out to investors every single month. This ETF has definitely made a big portion of my overall portfolio, and as of right now, I personally hold around 1,500 shares of DIVO throughout my portfolios. What might be even craziest of all is if we stack up DIVO next to the S&P 500, next to the SEHD ETF, the S&P 500's total return over the last 5 years is around 53%, where DIVO's total return over the last 5 years is 61.61%. SEHD's total return is number 1 at 65% more or less, but even still, with DIVO's performance beating that of the S&P 500, although this ETF might not get all the publicity that it deserves, it's definitely an ETF that the dividend more income-focused investors that are also interested in some growth definitely need to look into. Now, the last thing I want to go through when it comes to the DIVO ETF is this page right from their investor guide. From their website, it says the advantages of income-producing equity investments. Demand for these companies extend well beyond risk and return. Here are some additional reasons why investors continue to seek out dividend-paying companies, along with investment that generate income from conservative strategy of writing call options on positions already held in the portfolio. So with this, we have predictable income. There are thousands of companies that pay monthly or quarterly dividends and may have a track record going back decades. Not every dividend payer is worth owning though, of course, but the sheer number shows that the desire for income is ongoing and has definitely been growing in the past, it seems. It also says protection against inflation. Fixed income products expose investors to interest rate risk. Fixed payments lose purchasing power in inflationary environments, but companies can increase dividends, and based on an average of all rolling 12-month periods since 1940, dividend growth has exceeded inflation by an average of 2.4% per year. So obviously it's very hard to beat inflation, but investing into certain high-quality dividend payers that have a history of dividend growth can definitely help fight against it. Now also drives total return. According to the S&P Global, dividends have been responsible for 32% of the total return of the S&P 500 index since 1926. Adding a conservative covered call rating strategy overlay has helped the potential to help drive total return. And lastly, when it comes to dividends, let's talk a little bit about the tax treatment. Dividends paid by U.S. corporations or qualifying foreign equities are taxable to investors at rates ranging from, of course, 0 to 20%, rather than the investor's marginal rate, depending on taxable income. And with DIVO specifically, we might want to go over this all in a different video. Comment down below if you guys want me to go through this. But the way that most of DIVO's dividends are taxed are very favorable for investors like myself and likely even for you. But when it comes to DIVO, the Amplify Enhanced Dividend Income ETF, does DIVO currently have a spot throughout your portfolios? Let us know down below why or why not. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.